that said, I mean, as an accounting professor from MIT, from United States, what do you observe from the U.S. market or the global market? What is the trendy part of the accounting profession right now?
That's a great question. There's a lot of different trends that I think that I could point to that really interest me and excite me. The first is, I think what we're witnessing is a dramatic change in the economic landscape of companies, particularly within the U.S. So in the U.S., for many decades, we're primarily focused on manufacturing goods. And so the traditional companies, think companies like GM that produced hard manufactured goods, are no longer dominating the landscape of the U.S. markets. And instead, we're seeing a shift towards companies that provide goods and services. The stocks that people are primarily focused on these days, things like Google and Facebook and Amazon. And this has a lot of implications for not only accounting researchers, but for the way in which accounting is practiced. Many of the rules were written for companies that followed a different economic process than the way in which companies are operating now. And we need to update the way in which accounting is practiced in order to accommodate those trends. And so oftentimes people talk about accounting in terms of traditional notions, things like that asset value should decline with use. But instead, we're seeing a number of companies move in the opposite direction, where greater use of assets actually leads to greater value. So for people who rely on things like networks for value, things like Facebook or for Uber, oftentimes the accounting creates a mismatch between the value and what's recognized on the financial statements. And so this has wide-ranging implications for the way we think about valuation analysis because it changes the mapping between financial statement and information and values of companies. It's also the case that there are many processes and institutional, institutional mechanisms that amplify the problems associated with outdating accounting methods. And so I'll give you a simple example. Many financial institutions across the U.S. identify what are called value companies, companies that look cheap relative to fundamental value. And the way that they do that is they will typically sort stocks or identify stocks that where their book values appear relatively high relative to market prices, the so-called book-to-market ratio. The problem is, in the modern U.S. economy, many companies have artificially high or low book values that don't represent the residual value available to shareholders if the company were closed down today.
So by artificially high or low, what do you mean specifically by artificially high or low?
I mean, the traditional notion underlying accounting is that assets, equals liabilities plus shareholders' equity. So when you take all the assets of the company and you pay off all of their debts, their liabilities, the remainder that's left over, shareholders' equity, is meant to represent the claims that stakeholders have on the company. And so it's meant to represent the residual value that would be left over. But for many companies, if you took all their assets and pay off their liabilities, they may have negative shareholder value. But that's not representative of the fact that there are many assets that are valuable to the company, things like brand value or intellectual property, that are simply not incorporated into assets, but are a big part of the value that would be available to the companies.
So does that mean that we will need probably a brand new set of accounting standards to make the accounting rules more appropriate for these companies?
Not necessarily. It depends on the intended user base. It's not that accounting rules should be necessarily written for the purpose of valuation. We need a system for tracking changes in the economic value created. And of course, there are costs associated with incorporating components of a company's worth that are not things like hard tangible assets. So a big problem that exists within financial reporting is the fact that there's managerial discretion. And so if you think about things like brand value, it's really something that's difficult to measure. And so you could pose yourself the question, undoubtedly things like Coca-Cola's, their logo, or even sort of their themes are really valuable to the corporation. But it'd be hard to place a value on what that represents. And allowing companies the opportunity to represent that on their balance sheets, I think could pose more problems than it helps.
So if we do not change accounting standards, then what is the best way of helping the investors understanding the value of these brand names and so on?
Yeah, I think what we need are innovative ways for thinking about the value of companies to reflect the changing nature and economics of corporations. So they're no longer manufacturing firms, but towards service goods. And I think that we need to start thinking about companies in terms of their sustainable competitive advantage. So we've seen many corporations over the past decade that simply had no earnings, companies like Amazon, but instead had tremendously high valuations. What we need to think about is our abilities to forecast their longer-term cash flows, which should ultimately determine their value. But until we develop more sophisticated techniques for better forecasting those cash flows, I think that it's more subject to ambiguity. And in cases of ambiguity, more subject to potential mispricing.
Okay, so talking about technologies, there are a lot of technologies, new technologies out there, which is changing the landscape of accounting as well. Not only the landscape of the companies, but also the accounting itself.
Sure.
So, for example, AI. I think, as far as I know, the big four companies are already using the robots to do bookkeepings already, and also blockchain technology and so on and so forth. So, what do you think that these new technologies will change the accounting practices?
So, I think both artificial intelligence and blockchain are going to revolutionize the way in which accounting is practiced. So, take for example blockchain that will provide an immutable ledger. In terms of transactions for understanding the way in which people exchange value. Now, this is unprecedented in that it provides an irrefutable system, a way of verifying transactions. And I think that in many ways people are concerned that blockchain will take over the role of accountants. What I would argue is that blockchain is very likely to be revolutionary, but change the nature in which accounting is practiced. So rather than accounting sitting down to do T accounts, to think about recording transactions by recording a general ledger, I think accountants will be very much engaged in the financial reporting process as a way to think about the output of blockchain, the general ledger, and to make sense of the transactions that are recorded. Because a big part of the financial reporting process is the discretion that's afforded for managers to represent changes in economic value. So there are many transactions that are part of a broader system within financial reporting that are meant to provide managers with discretion in terms of thinking about what has changed within the company. A simple example are things like accounting for allowance for doubtful accounts. For a company, when a company issues credit to an individual, the likelihood that that individual is unlikely to pay. While things like blockchain can account for the transactions or sort of the agreement to engage in exchange of service, we still need accountants for figuring out what should we record in terms of things like revenue, which is certainly a big portion of what companies or investors are looking for in determining firm value. So I think that the application of blockchain is very likely to change the nature of accounting by shifting focus of how technology should be aggregated and ultimately used to summarize fundamental information about a company. Similarly, artificial intelligence holds wild promise for a variety of fields, and certainly accounting is counted among them. Artificial intelligence is very likely to be useful in determining cases where companies are manipulating their profits. It's likely to better understand the value of companies through learning by understanding where hidden or latent information exists within financial statements. But again, this is not in a change or threat to the field of accounting, but rather a change in the nature and focus in terms of the way in which accounting is going to be practiced. So whereas traditionally accountants would simply only have the need to understand the way in which accounting should be operationalized, that is, thinking about how GAAP procedures should be applied, I think there's going to be a new avenue for understanding how to engage with computers. Those who are engaging in artificial intelligence, to train computers to look at the right components, to provide a platform for thinking about the way in which accounting is practiced and how it can be harnessed to be used for a particular application, like valuation, for detecting fraud, for understanding limitations of the financial reporting process, and hoping setting new standards that could ultimately serve the investing public or stakeholders more broadly.
So, are you aware of any current cases in the U.S. or anywhere else where that they are employing robots or AI to do fraud detection in financial statements already?
Absolutely. I think that we're seeing this not only in application in which companies, audit companies, as well as hedge funds are beginning to use artificial intelligence to determine the value of companies or to understand irregularities within financial reporting. Mm-hmm. We're also seeing a wave of academic research which provides a testament to the value of these technologies. Mm-hmm. And what these papers or research studies are doing is that they're allowing artificial intelligence to determine what is suspect within a set of financial reporting. That is, it allows us to better understand the mapping between observed financial reporting and outcomes, things like restatements or ultimate fraud. Mm-hmm. Because by better understanding that mapping, we have a good indication of sort of key variables that we should be paying attention to. Where are the places that managers are exercising discretion, and what we should be looking for as an active investor to figure out, what are the sort of the key triggers or signs something is going wrong.
So after, even despite all these new technologies, accounting profession will still exist for a long time.
That's my forecast. Yes, that's right.